Sometime next month, a $1.75 trillion company is going to be dropped straight into the middle of the U.S. stock market.
They're right into the deep end.
And whether you care about rockets or not, your retirement account is basically going to be forced to sell off shares of Apple, Microsoft, and Google just to buy it.
Right. It is the absolute definition of a structural market shock. I mean, we're looking at a fundamental rewiring of how money moves.
We really are. It is late May 2026, and the financial world is entirely consumed by what is expected to be the largest initial public offering in history.
SpaceX is finally going public.
Exactly. And they're aiming for an astronomical valuation of up to $2 trillion, raising up to $75 billion in cash.
Which is just a staggering number.
It really is. But, we aren't here to talk about Mars colonization or satellite internet today. We have a massive stack of sources for today's deep dive.
Yeah, we've got SpaceX's formal financial prospectuses, academic papers on market mechanics, union letters sent to the SEC, and expert commentary.
Because the mission for today is clear. We want to look past the flashy rockets and uncover exactly how this massive IPO is about to directly impact your passive index funds.
Right, whether you actively choose to invest in it or not.
Okay, let's unpack this. Imagine your passive index fund is an automated personal shopper.
Okay, I like that.
You send this shopper to the grocery store, right, with strict instructions to buy a proportionate slice of everything on the shelf.
Right, they just buy the whole market mechanically.
Exactly. But suddenly, a massive $1.75 trillion artisanal cheese wheel is just placed in the middle of the store.
And your shopper has to buy a slice of it.
They have to. But where does the money come from? Because your monthly retirement contribution hasn't changed.
Right, it comes from selling everything else. Passive index funds now account for well over 50% of all investments in U.S. stocks.
Over 50%. Wow.
Yeah, it's huge. And these funds don't actively pick stocks. They just mechanically mirror an index. So to afford that giant SpaceX cheese wheel, managers have to sell portions of their existing mega-cap holdings.
So they're dumping pieces of Google, Apple, or, even Tesla.
Exactly. Goldman Sachs actually noted in our sources that U.S. equity mutual funds are already hoarding cash right now to absorb this benchmark addition.
So they're bracing for impact.
They are. It creates what the analysts call a capital cannibalization effect. The S&P 500 alone might have to absorb up to 19% of SpaceX's public float.
19%? That's incredible.
It leads to an estimated $44 billion in forced selling of other assets just to make room.
$44 billion.
What's fascinating here is the structural bid this creates. This mechanical buying essentially forms a powerful post-IPO price support.
Right, because they have to buy it no matter what.
Exactly. But it's an algorithm-driven demand, not discretionary. Nobody is looking at the price and deciding if it's a good deal.
But wait, if these funds are mathematically forced to buy, isn't that just a massive guaranteed safety net for SpaceX insiders who want to cash out?
It's a great point.
Like, are passive investors just acting as the world's biggest liquidity backstop?
That is exactly what a lot of critics are arguing right now. And it leads to the question of when this forced buying actually happens.
Right, because historically, didn't index funds wait months for a new stock to kind of season?
Yes, normally they wait for the market to find a fair price over 12 months.
Yeah.
But right before this IPO, the rules of the game suddenly changed.
Which is incredibly convenient. And to understand that, we have to look at what the sources call the illusion of the free float.
Ah, yeah, the free float reality.
Because despite the $1.75 trillion headline valuation, SpaceX is only offering a tiny sliver of its shares to the public.
Right. It's estimated to be between just 3 and 4%.
Exactly. But index providers have basically rewritten their inclusion rules at the exact same time. NASDAQ introduced a fast entry rule allowing inclusion in just 15 trading days.
In CRSP, which is the index that Vanguard uses, along with FTSE Russell, they dropped their wait times to just 5 days for megacaps.
5 days. That is barely any time for a stock to find its footing.
It isn't. And NASDAQ went even further. They changed their methodology to cap effective shares at 3 times the free float.
Wait, what does that mean? 3 times the float?
It means they're allowing a low-float company like SpaceX in early, while artificially boosting its weight in the index as if there were 3 times as many public shares available.
Oh, wow. So commentators like George Noble are calling this the passive indexation trap, right?
Yes. Noble notes that these rule changes allow companies that are burning billions of dollars to entirely bypass the standard 12-month seasoning period.
That feels like a huge shift.
This raises an important question regarding the neutrality of index providers. There's a real tension here between providing a true representation of the market and bending rules.
Bending the rules just to capture the fees and, like, the prestige of the largest IPO in history?
Exactly. They are competing businesses after all.
Okay, let me just clarify something. So, because the float is only 3 to 4%, the actual weight of SpaceX in your portfolio will be based on that tiny slice, not the massive $1.75 trillion headline number.
Yes, exactly. And that is a crucial distinction.
So we know the rules have been changed to let SpaceX in early. Now we need to map out exactly how this plays out across specific, popular index funds that you might hold.
Right, because it hits different funds at very different times. Let's look at VTI and VT.
That's the Vanguard Total Stock Market and Vanguard Total World Funds.
Right. These will buy SpaceX almost immediately. VTI tracks CRSP, which triggers 5 days post-IPO. VT tracks FTSE, which is also very fast.
But because they strictly use float-adjusted capitalization, the actual exposure is tiny, right?
Extremely tiny. Based on the data, it's roughly $70 to $110 of SpaceX for every $100,000 you have invested in those Vanguard funds.
That is basically a rounding error. But what about QQQ, the NASDAQ 100 fund?
That is a very different story. This fund will buy in 15 days. And because NASDAQ applies that new 3x multiplier to the float, QQQ investors are going to be the most heavily exposed.
Oh, because of that artificial boost. So how much are we talking about?
You are looking at about $470 to $700 per 100,000 invested.
Wow, so way more than VTI. And then there is the S&P 500 funds like VOO, SPY, IVV. Will they buy SpaceX right away?
No, the S&P is the lone holdout for now. Even with proposed rule changes to drop their profitability requirements, SpaceX likely won't be eligible until around mid-December 2026.
So what does this all mean? Our sources offer some actionable strategies here.
They do. If you want to target SpaceX, the sources point to QQQ for the highest concentration due to that 3x multiplier.
Or VUG, the Vanguard Growth Fund, which gets in after just 5 days.
Right. Now, on the flip side, if you want to avoid SpaceX, you can park your money in S&P 500 funds like VOO to delay your exposure for at least 6 months.
And to avoid it entirely, Elm Wealth mentions equal weight S&P 500 ETFs like RSP.
Yes, but the sources heavily warn that RSP has much higher fees. It charges 0.20% versus VTI's 0.03%.
And doesn't it have like a 20% annual turnover rate?
It does, which creates tax drag.
Yeah.
So mathematically, the cure might be worse than the disease there.
So for the average retail investor, holding a diversified passive portfolio just means you'll pick up SpaceX automatically, but the weights will be relatively modest.
That is the reality, yes. It will just be a small sliver of your holdings.
Okay, but even if it's a small sliver, we know exactly how much SpaceX you were forced to buy. We should probably ask, what is the actual financial health of the company you are buying into?
That is where the S1 prospectus comes in, and the picture is very complicated.
Yeah, are retail investors being set up to take a loss here?
Let's break down the business. First, you have Starlink, which is undeniably a profitable cash cow.
Though the sources note the average revenue per user is dropping as they expand globally.
True. Then you have the launch business, which is bleeding cash to fund Starship. And Starship hasn't even delivered a commercial payload yet.
And finally, XAI, which is just hemorrhaging cash. I think the filing showed $12.7 billion in CapEx.
Yes, $12.7 billion in capital expenditures just for AI infrastructure. So when you combine all of that, SpaceX lost nearly $5 billion last year.
$5 billion, and it's trading at over 94 times its sales.
Exactly.
Yeah.
And the S1 also reveals massive related party transactions that are raising eyebrows.
Right, like the $690 million spent buying Cybertruck.
Yes, and billions in computing leases, signed with a fund run by Antonio Gracias, who is a SpaceX board member.
That is a massive corporate governance red flag, which is why the AFT wrote to the SEC, right?
Yes, the American Federation of Teachers. They represent 1.8 million workers and manage huge pension assets.
They basically warned the SEC that these fast-track index rules force their members' retirements into an unproven high-risk asset.
Exactly. And then there's the hidden tax element, which is fascinating. Academic research by Haddad and colleagues shows how fast-track IPOs get manipulated.
Here's where it gets really interesting. Hedge funds front-running the index funds.
Right. Hedge funds know the exact day Vanguard has to buy. So the stock surges right before inclusion day, and then sharply declines over the next 2 weeks.
So retail investors in index funds act as the exit liquidity, right? Just absorbing this hidden tax.
Yes, that is the academic consensus. But there is a strong counter-argument.
Right. From the experts at Elm Wealth and Jacob Friedman, they argue that you really shouldn't panic.
Exactly. They run the math and say, even if SpaceX is vastly overvalued and drops 50%, the overall drag on a broad index fund is mathematically tiny.
Because the public float is so small, right?
Yes, a 50% drop would only drag the index down by about 0.2%.
Which is the equivalent of what the market naturally moves in like 30 minutes on a typical day.
If we connect this to the bigger picture, both sides have a point. The percentage drag on your portfolio might be tiny, mathematically speaking.
But the union's governance concerns are totally valid too.
Exactly. The structural precedent of fast-tracking cash-burning megacaps into public indexes is a massive shift in how capital markets operate.
It is a totally new era. So to wrap up this deep dive, while the SpaceX IPO is a historic event full of sci-fi ambitions and astronomical valuations,
Its immediate impact on your wallet comes down to the dry, mechanical rules of your specific index funds.
right, QQQ investors will see the most action quickly, VTI will see a tiny sliver almost immediately, and VOO investors will basically be waiting until the winter.
Which leaves us with a final thought to mull over. For decades, passive index funds were praised as the ultimate safe harbor.
A way for everyday people to invest in the proven, profitable engines of the global economy.
Exactly. But as index providers rewrite their rules to immediately absorb heavily hyped, cash-burning megacaps, we really have to ask a hard question.
Are you still a passive investor in the public markets?
Or have you unwittingly become a passive funder for Silicon Valley's venture capital?